Well, good morning. This is Dean Tenney. I'm coming to you from my fabulous studio here in Las Vegas. We're continuing through the explication of the test specification, NASA test specifications. On each of our playlists, when you go to your series that you're studying for, there's a playlist, and we typically try and offer some narrative lectures and explication of test content outlines in FINRA's case, test specifications in NASA's case, as well as a practice exam, one or two or three. And we are closing out, hopefully getting the explications done for NASA exams. We have completed SIE. We've completed 7. So this should be the last leg of your testing journey. So if you have people who are just starting their testing journey, please refer them to the channel and their playlist, whether it be SIE or Series 7, 6, whatever the case may be. Okay, for us this morning, we're going to be doing a section J of NASA's test specifications about trading securities and terminology or nomenclature. It's like learning a foreign language. What do they say? When you dream the foreign language, that's when you know it. So I guess when you're getting comfortable with this language, you're in good shape. And so the first thing that we have in markets, trading securities, are what we're going to call bid prices. The bid. Let's see there we go. But my screen was locking up. And an offer or ask price. The bidding offer is always from the dealer's perspective. The dealer, for our purposes, dealer, market maker, we'll call broker dealers from the dealer's market maker perspective. And what that means is perspective. I think I'm spelling it right. I think a good analogy is the car business. In the car business, if I go into a Lincoln Navigator, Lincoln dealer and say, how much for Lincoln Navigator? He goes, Dean, $90,000. I go, great, I've got one. Where's my $90,000? He says, well, Dean, I misunderstood you. I thought you wanted to, turn money into a Navigator, and I gave you my offer or asking price. Now I understand that what you want to do is turn a Navigator back into money. And so you need, Dean, my bid price. And so let's just change colors here. This is the price at which the market maker buys and the customer sells. Let's change colors again. I think the way I think you can keep it straight, perhaps, is the customer always pays the high price and always receives the low price. What's that called? The securities industry. And that's how we make our living, the difference between what we buy things at and we sell things at. Whoop. And boop, 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 boop. And customer. And that means market maker. And then the difference between the bid and the offer is called the spread. So the difference between that and that's how, dealers, market makers make their difference, make their living on the spread. The difference between what I buy securities into my inventory and what I sell securities out of my inventory at. Alexa, spell perspective.
Perspective is spelled P-E-R-S-P-E-C-T-I-V.
There we go. Fix that. So bids and offers, those are called quotes. So when I give you a quote, if I respond to you as a market maker, you say, hey, Dean, what's your quote? And I respond 1516. That's my quote. Now, that doesn't mean we've done business at that. I mean, in the market making, all the securities that trade over the counter are said to trade in a negotiated quote driven market. And so that's how we get started with this quote. And so the quote is what gets things running. Now, as a market maker, I stand willing to buy at least 100 shares at my bid and sell 100 shares at my ask as a market maker. So bids, offers, quotes. Let's just put something there. Let me go back to red here. No, all quotes are considered firm for 100 shares. So if I'm a market maker and I give you a quote, I have to stand willing to honor that for at least 100 shares. At one round lot. So, let's add some size up here. Maybe I say my size. No, I know without anything, it's 100, but if I put 10 by 10, that means I have to honor 10 round lots. 10 round lots. That's 1,000 shares. And, if I don't, then you're going to say, hey, as an investment advisor representative, if you're concocting to me, the market maker, and I don't honor that quote, you say, Dean, are you backing away? Backing away is when a market maker fails to honor a firm quote. A market maker or dealer, for our purposes, those are synonymous terms. In stocks, we call them market makers, and bonds, we call them dealers, but it's the same general idea. Anyways, backing away is when a market maker or dealer fails to honor a firm quote. Okay, so again, if you're an investment advisor representative and you're doing business with a broker, the assumption is you have trading authorization. You're going to call a broker and say, hey, buy 1,000 shares in Mr. Smith's account at the market. And at the market means you want immediate execution at the best available price. You're more interested in execution than you are price. That's the only order, by the way, the only order that has no contingency, no qualifier. What we mean by that is if, you're more interested in execution than price. All these others have a qualifier. A limit order means you want to do business at your price or better. So now I'm the broker and you call me, you're the investment advisor representative. You say, Dean, in Mr. Smith's account, let's buy 1,000 shares at 18. Let's buy 1,000 shares at 18. Now, it's my job as the broker to know that's a limit order, and you're telling me that you want to do business at your price or better. Now, nobody has to do business with you at your price or better, but in the limit order saying you want to do business, a price is more important than execution. And there's as a buyer, your price or less on a buy limit, let's put that. The customer's price or less. And that would be placed below the current market price. Let me get a different color here. That would be placed below. CMP means current market price. And then we also have sell limits. And so again, the same thing, the customer's price in this case or more. And this one, let's change colors again. The settlement is the customer's price or more, and that would be placed above the current market price. We have stop orders. The number one use of a stop order is to stop a loss. And so that's why they're called stop orders. Yeah, and I have two versions of a stop order. Again, 66 is 2 questions in this category. 65 is 4 questions in this category. Unfortunately, we don't know, 2 or 4 what questions you're going to get. So that means you're just going to have to, I guess, do the work here. So this is kind of like options. I'm not sure how far we want to go on this, but anyways, we're going to place a sell stop. I'm not going to go into sell stops for anything other than to stop a loss in a long position. I'm not going to go into, using it to establish a short position or to, protect a profit. That's what they're primarily interested in as an investment advisor representative. And if you are a recently minted 7, this should sound familiar to you. There's, that's why there's only 2 questions for 66s and 4 questions for 65s. And then a buy stop. Let's make sure we got this one. Let's put this here again. We have a great mnemonic, slobs over bliss. And that's just to remind us where orders get placed in relationship to the current market price. And let me get a different color again. This is going to be placed below the current market price. And again, these aren't lectures. I have a whole trading lecture, a whole types of orders lecture. This isn't a narrative lecture. This is an explication. So if you feel like you need more, background behind the explication of the test specifications, go grab those narrative lectures in the playlist and you can get full narrative lectures rather than what this is, which is the explication. Anyways, buy stops are used to stop a loss in a short position. There are other uses, but I'm not going to go over those in the explication because that's not what they're looking for in terms of your exam. What they're looking for here is this idea. And the buy stop is placed above the current market price. That would just be a smart thing to do if you're going to be foolish enough to sell borrowed stock. And that's what short sales are. A short sale. Again, I'm using the 66 test specification, but 65s, this is the exact same document in your test specification. So as I've said before, rather than call this 65, 66 and have a combination, which I find aggravating, when there are common content and the only difference is numbers of performance opportunities, 2 for 66s and 4 for 65s, performance opportunities, test questions, then I just do it once, but I put it in this different playlist for you. And when it's content that is unique to either the 65 or 65, 66 or 65, then I do it separately. So that's why this says 66 test specifications instead of 65, even though it's exact same stuff. So if that's confusing, just leave a comment and I'll make sure I do a better job explaining it. But anyways, selling short is selling borrowed stock. Most businesses, when you sell things you don't own, it's called fraud, but not our business. And all short sales must be conducted in a margin account. And what you're hoping here is to sell high and buy low. Whether you want to borrow money or borrow stock, you need a margin account. Now, if you don't do something besides that, you're going to be exposed to unlimited risk. And so, as we just said, one thing you might want to do is enter. It would behoove you to enter a buy stop or from future or past explications by a call. And then you would no longer have unlimited risk if that's what you did. So, that's short sale. And we have 2 types of basic accounts. The 2 basic types of accounts in a broker dealer are cash accounts where you intend to pay in full. It's very testable to know that certain accounts are required to be cash accounts. The big one would be an UTMA account. UTMAs must be cash accounts. And a margin account, remember, you want to pay part of the purchase price and you want the broker dealer to loan you money. So on a margin account, and that's going to be leverage. we're going to make you put up half. You're going to, be at risk initially for 50%. The brokerage firm is going to lend you 50%. So that means you're going to be making money twice as fast, but that also means you're going to be losing money twice as fast. So the same supercharged speed you're going to be making money with is the same supercharged speed you're going to be losing money with. When we do principal trades, those are also known as dealer trades. And if in the confirmation, we're always going to tell you this is called capacity. Color here. So I said, well, when you open an account at Goldman Sachs, we're a broker dealer. And in some transactions, Goldman Sachs will be acting in its dealer principal capacity. And in our dealer principal capacity, we'll be charging you a markup or a markdown. We're going to be trading against you. So in a principal or dealer capacity, so it'll say Goldman Sachs acted as a principal in this transaction. So in a dealer principal transaction, we're going to be charging a markup or markdown. And again, I'll just put that in different colors here. So in my example of Goldman Sachs, if they're charging a markup, that means the customer is buying. I'm sorry, I was going to put that in a different color. It didn't seem to register there. Let's try it on this next one. Markdown. Customer is selling. And that'll be disclosed on every confirmation. Now, in an agency trade, we're acting in our broker capacity, broker agency capacity. And broker agency means we're going to be charging a commission. And that means on your behalf, we, as a broker in our broker agency capacity, we contact another firm and you bought it from them. So that's, what that means. That'll be disclosed on every confirmation. So we're all called broker dealers, but in any one trade, the role of the broker dealer, right? In any one trade, the broker dealer is going to be acting either in its broker or agency. Can't be both. So capacity needs to be disclosed. Disclosure is typically made on the confirmation, and the broker dealer can never be a broker and a dealer in the same trade. I mean, it kind of makes sense. I mean, how could I at Goldman Sachs represent Goldman Sachs at the same time I'm representing you? I really work myself for you, and now you owe me, commission. Again, I have a whole hour and a half narrative lecture on trading. I take it as a compliment. One of my competitors said, Dean's lecture is overboard. After you watch it, you could get a job as a trader. I took that as a compliment. So that's available for you. Again, this is an explication. There's all kind of memory aids to help you with, ABC, agency, broker, commission. I'll leave it to you to go do some more work on that. High frequency trading. There's two versions of what people think about high frequency trading. This is where, high frequency trading firms use, milliseconds, to do what's called arbitrage. Arbitrage is profiting from price discrepancies. Yeah, and they have computing power that just totally outweighs, or is way, better than what retail customers kind of have, right? So as a retail customer, if you're a retail customer, you think this is a positive thing. So let's make what the test question is. From the high frequency trader's perspective, they are adding liquidity to markets. And that's a good thing. And, from a retail investor's perspective, We think they may be, perhaps they're front running, trading ahead. They're brigands on the highway of trade. I think, again, the idea here is that, we don't, as a retail, it's not a level playing field between these, high frequency trader algo guys and, people who don't have access to, data feeds and things like that are much faster than what I'm coming to you from a retail internet connection in Las Vegas. Anyways, dark pools, it's considered dark because the parties are anonymous. If you're an institutional investor, particularly, you probably don't want people knowing your business or knowing who you are. And so you could trade in a dark pool, and dark just means anonymous. You're still going to have to report trades once they're done. Alexa, spell anonymous.
Anonymous is spelled A-N-O-N-Y-M-O-U-S.
I'll put it in a fancy language, counterparties. So as I mentioned, institutional investors sometimes like to trade amongst themselves without, T. Rowe Price telling BlackRock it's BlackRock or BlackRock T. Rowe Price. Once we do the trades, then they're reported. But anonymous means you're trading, and again, that makes it hard for people to pick up on, institutional trading, trying to front run perhaps on you. So anonymous counterparties, hence the term dark pool. We talked about the role of the broker dealer. Custodians, I just read where State Street Bank and Trust just lost BlackRock as a customer. That's huge. But custodians hold monies in securities. I used to tell people, when I was a practitioner, I can't steal what I don't touch, and I don't have access to your monies in securities. And we talked about market makers, and we said market makers are associated with the over-the-counter market. And over-the-counter, or over-the-counter markets can best be characterized as negotiated quote-driven market. So what that means is what we're kind of hinting at is if you're an investment advisor representative and you're trading in the OTC market, you got to be a little more careful because the market makers are trading against you, right? Markups and markdowns, we kind of discussed that. You got to be a little more careful. In an exchange market, those can best be characterized. If you get this, that's the test question, by the way. Over-the-counter markets can best be characterized as negotiated quote-driven markets. Where exchanges can best be characterized, the model they use is New York. They've been down there since 1792, matching buyers and sellers. And exchanges are best characterized as auction order-driven markets. I think the good analogy would be the art market, right? Sotheby's and Christie's are auction houses. They don't have inventory in art. They're simply matching buyers and sellers and taking commish. And if you're a novice in the art market, you might want to go to Sotheby's and Christie's to trade because, again, they're not trading against you. In the art market, if I'm an art dealer, that means I have already an inventory. And then what I do is charge a markup or a markdown. We talked about commissions. Commissions are associated. Let's just put that in there. Let's get a different color. Those are associated with agency trades. And we said markups are associated with dealer. A different color here. Dealer market maker transactions. The spread, we says the difference between the bid and the offer. We talked about that. Now, be careful on this best execution thing. Best execution is kind of a trick. And what I mean by that is a kind of a trick. Is, assuming there's the best price. I'm not required to do business with the market maker or dealer that has the best price. I simply have to try and get my customer best execution. But best execution doesn't necessarily mean the highest bid or the lowest ask. It just means it's got to be competitive. And what we mean by competitive is, this is one of the dangers in terms of reputational risk. I mean, you say, well, Dean, given that there was a better quote, why did you, as my investment advisor representative, choose to do it there at XYZ instead of doing it over there at ABC? And I said, well, I don't think ABC is going to be here on T+2 to settle the trade. That's one thing. Or, I, as an investment advisory firm, we receive soft dollar compensation from our broker dealer. We direct the transactions there. we still think it's competitive and there's additional products and services available to us. So it's not necessarily best execution, it's competitive. So let's just make sure we don't fall for that trick. We have an obligation to get the customer best execution. That does not necessarily mean the best price. Now, we also, some broker dealers receive payment for order flow. And if I am a order entry firm and I'm receiving payment for order flow, well, then it does mean that my preference market maker would always have to honor to me what's called the inside market. And, I'm going a little overkill here, but. And the inside market is the highest bid, the highest of the low prices, and the lowest ask, the lowest of the high prices. Okay, I'll again refer you to the market making lecture, the trading securities lecture, which is an hour and a half in the narrative form. And that concludes this installment of the explication. If you are a 65 or 66 and you are doing this, you're going to notice I kind of jumped over, skip some sections. I'll circle back and I'll close those gaps at some point. And I see I got to do some checking myself. I'm not sure, what kind of gap we have. Anyways, we're coming up on our 1-year anniversary of the channel. It's been what a ride this year. We've got over 200,000 views. We're closing on 3,000 subscribers. I'll be putting on an annual report, as I mentioned. Please share, subscribe. Make sure you circle back with those just starting the testing journey and send them to the channel. And I'll see you at some future time for the next installment of the Explication NASA Test Specifications. Bye-bye.